Has the recent China-US trade clash exposed weakness within China's manufacturing dominance? China went too far in the trade war with the US, with levies up to 145%, and now an internal price war has started. Chinese auto companies suddenly started offering big discounts of up to 34%. EV growth in China is eroding the gas car market, and not just that. China's auto giants like BYD and Great Wall Motors are reportedly exchanging heated arguments, all while the BYD stock market taking a plunge day after day. But what is China's government strategy after all the chaos? Is this the beginning of the end for China's dominance in auto manufacturing? Hit the like and subscribe button for more updates, and let's get into the details. BYD has lit a fresh match under China's already raging EV price war. The company slashed prices on 22 models, bringing the entry-level Seagull down to 55,800 yuan. The Seal 07 DMI saw a 53,000 yuan drop. These aren't small tweaks, they're game-changing moves. The average car price in China has already dropped 19% over the past 2 years to 165,000 yuan. Battery-only EVs fell 21%, hybrids plunged 27%, and even combustion engine cars dropped 18%. So what's behind the drastic cuts? There's a glut of inventory. 150,000 extra vehicles in BYD's dealership pipeline alone as of April 2025. City analysts predict these cuts could spike weekly sales by 30 to 40%, helping to clear stock. But this also exposes a problem. Demand isn't keeping pace with production. While BYD's growth is impressive, the broader economy is sluggish. Government subsidies are tapering, consumer sentiment is shaky. Add Tesla's earlier price cut strategy, and you get an oversupplied market where automakers are using price, not innovation, to compete. Old car companies are worried. This is not just about fewer sales, it's about how more electric cars are making it hard for gas cars to compete. The numbers don't lie. Internal combustion engine vehicles are steadily losing ground. In the US, their market share fell 2.3% in the first half of 2024, the biggest drop of any category. Meanwhile, electrified vehicle sales, including BEVs, hybrids, and fuel cells, surged to 386,000 units in Q2, claiming nearly 10% of the US light-duty vehicle market. Globally, the trend is the same. Over the last 8.5 years, the gas car market lost 19.1 percentage points of market share. Traditional hybrids gained 10.3%, BEVs gained 7.1%, and plug-in hybrids gained 1.7%. Toyota's all-hybrid 2024 Camry lineup is not a one-off, it's a signal. Fuel economy, maintenance savings, and emissions cuts are pushing consumers to rethink combustion. EVs with up to 70% lower lifetime emissions are a no-brainer for eco-conscious buyers. Charging infrastructure is catching up too. 140,000 public stations now exist in the US, up 30% in 2023 alone. Sure, range anxiety and costs still worry some consumers, but as long as the savings keep stacking and climate concerns mount, ICE's days are numbered. This shift is part of what's fueling anxiety and aggression in China's auto market. This brings us to the recent public clash between BYD and Great Wall Motor. The battle has begun. Great Wall Motors chairman Wei Jianjun said China's electric car market is like the Evergrande problem, a huge, debt-filled mess ready to fail. He didn't say names, but everyone knew he meant BYD. BYD didn't take it lightly. The company's PR chief fired back, calling Wei's comments alarmist, and defended BYD's 70% debt and large debt as costs of growth. BYD had a $9.15 billion profit in Q1 and a 20% gross margin, which is better than Tesla's 16%. Still, the shots hit home. Auto stocks, including BYD, XPeng, and NIO, tumbled after Wei's remarks. BYD also threatened legal action against users fueling the speculation. This isn't their first fight. In 2023, the Great Wall accused BYD of emissions violations. BYD responded by calling for a united Chinese auto front to beat global rivals. The subtext: old rivals, new weapons, same brutal fight for dominance. With tensions escalating and margins thinning, government officials are stepping in. Beijing's patience is wearing thin. On May 31st, China's Ministry of Industry and Information Technology issued a rare, blunt statement. There are no winners in a price war, let alone a future. The China Association of Automobile Manufacturers echoed the call, warning of a vicious cycle that could gut profitability, hurt R&D, and degrade product safety. Their core concerns? Dumping products below cost, undermining small players, and creating a rat race environment. BYD's aggressive cuts were the trigger, and several rivals like Geely and Chery immediately followed suit. The government now vows to crack down on unfair competition, even threatening regulatory action. This is more than policy talk, it's a red flag. Automakers are pushing short-term volume at the expense of long-term viability. The average gross margins across the sector are slipping, and industry-wide profitability is eroding. Officials are urging automakers to focus on cost innovation, not undercutting. If brands can't self-regulate, Beijing may enforce orders, from stricter inspections to penalties for anti-competitive behavior. While China deals with its own problems, car issues aren't just in Asia. In the US, Ford faces big trouble. While BYD fights a public battle at home, Ford faces a quiet but dangerous crisis. Its financing arm, Ford Credit, has $1.3 billion in bonds maturing in March 2026, and that's just the beginning. In total, Ford has floated over $3 billion in new debt since early 2025, all while extending multi-year auto loans to customers. Here's the problem. Ford uses short-term money for long-term loans. This is risky. If money becomes harder to get or interest rates go up, Ford could be in trouble. Its BBB- rating from Fitch helps, but one downgrade could greatly raise borrowing costs. Toyota had a large $153 billion debt safety net, and Subaru paid off all its debt this year. But Ford's finances seem unstable. What's worse, people are borrowing more money for cars and loans are lasting longer than 7 years. This will be a problem if more people stop paying their loans. Ford's stock is lagging, trading at a discount. Some investors see a value play, others see a risk trap. The big test will come in early 2026. If Ford can't refinance smoothly, the dominoes could start to fall. And as global automakers juggle debt, discounts, and demand, the big question remains. What's next for BYD, GWM, and China's auto landscape? For BYD, short-term pain could lead to long-term dominance. Yes, shares dropped 8.6% Monday and another 4% Tuesday, but the company's fundamentals are solid. It sold 380,089 NEVs in April alone and just beat Tesla in European sales for the first time, with 7,231 BEVs registered in April, up 169% year-over-year. While Tesla battles image issues, BYD is expanding aggressively in Europe and Southeast Asia. The company is also rolling out advanced driver assist tech using DeepSeek's R1 AI, aiming to undercut Tesla's FSD at scale. And it's not vulnerable to US tariffs since it doesn't sell cars there, an edge as geopolitics heat up. Great Wall Motor, on the other hand, has leaned into public criticism, perhaps to signal financial discipline or build pressure for regulatory action. But if it can't match BYD on scale, tech, or pricing, it risks losing ground fast. Meanwhile, regulators will likely keep tightening the reins. We may see rules on minimum pricing or cost transparency. CAAM's push for healthy competition isn't just talk. It could shape the future, force consolidation, and even limit expansion overseas. Bottom line, the real war isn't over price. It's over who survives long enough to dominate the next era of mobility. So, BYD sparked an EV price war with sudden discounts. Gas cars rapidly started to lose ground as hybrids and EVs surged. Great Wall Motor clashed with BYD, comparing the auto sector to a financial time bomb. China's regulators stepped in to stop the bleeding, and Ford facing a serious debt test that could shake US auto finance. The landscape is shifting fast. Can the automakers balance aggressive growth with real financial health? And who do you think will lead the next chapter of the global EV race? Comment below. Hit the like and subscribe button for more updates. See you in the next video.